Disclaimer.
What if I told you that one American military strike and a single decisive moment in the mountains of Jalisco, Mexico, just froze more silver than the entire annual output of Australia, Russia, and Peru combined? Not metaphorically frozen. Physically locked behind burning tires, armed checkpoints, and the fury of the most violent criminal organization on the Western Hemisphere. And right now, as you're reading your brokerage statements and watching silver tick quietly on your screen, most Americans have absolutely no idea this is happening. Let's go back to February 22nd, 2026. It's a Sunday morning in the highlands of Jalisco State, and Nemesio Oseguera Cervantes, the man the world knows as El Mencho, the founder and supreme commander of the Cartel Jalisco Nueva Generacion, is neutralized in a coordinated U.S.-assisted strike. For years, El Mencho was the most wanted drug trafficker on the planet, a $10 million DEA bounty hanging over his head, a man who once shot down a Mexican military helicopter with a rocket launcher just to prove a point, and just like that, he was gone. Within hours, the reaction was unlike anything Mexico had seen in a decade. CJNG lieutenants activated contingency plans that law enforcement analysts later described as remarkably pre-organized. Convoys of armed men fanned out across Jalisco, Zacatecas, and Sonora states. Highway blockades appeared on major federal routes almost simultaneously. Trucks burned sideways across roads, mining access paths barricaded with heavy vehicles. Local officials in Guadalajara reported that movement in and out of several key industrial corridors had dropped to nearly zero by Sunday evening. This wasn't spontaneous chaos. This was a shutdown protocol. Here's what should grab our attention immediately. The regions that went dark first weren't random. They were Mexico's silver heartland. Jalisco and the neighboring states that CJNG controls or contests produce roughly 190 million ounces of silver every single year. That's not a footnote in Mexico's economy. That's approximately 24% of the entire world's silver supply, all flowing through territory that, as of February 22nd, was under active cartel lockdown. But to understand why this matters so much to our wallets, our retirement accounts, our industrial investments, we need to understand something that took financial analysts years to piece together. The cartels weren't just taxing silver mines, they were hoarding silver itself. Think about how criminal organizations have traditionally stored wealth. Drug cash is difficult, it's bulky, it smells, it draws attention, it degrades, and moving it across borders requires an entire parallel banking ecosystem. Cryptocurrency seemed promising until blockchain analytics firms and federal seizures proved it traceable. Real estate is too visible, too slow, too tied to jurisdictions. But silver? Silver is dense, anonymous, universally liquid, accepted everywhere on Earth without a single question asked, and it carries no digital footprint whatsoever. A single standard pallet of silver bars contains roughly $1.5 million in value. You can move it on a farm truck, you can bury it, you can melt it. This is what intelligence analysts at the DEA and Treasury's Financial Crimes Enforcement Network had been documenting quietly for years. That major Mexican trafficking organizations, particularly CJNG and the Sinaloa Cartel, had developed what insiders began calling blood reserves. Physical precious metals, primarily silver given Mexico's natural abundance of it, stockpiled as operational insurance against asset seizures, banking disruptions, and geopolitical turbulence. When your entire business model depends on logistics that can be disrupted overnight by a government crackdown, you want your reserve currency to be something no government can freeze with a keystroke. The scale of these reserves, when aggregated estimates from multiple intelligence assessments began circulating in financial security circles, was genuinely staggering. Working from mine output data, known cartel taxation rates on mining operations, historical seizure records, and cross-referenced commodity flow analysis, analysts converged on a figure somewhere in the range of 6,300 metric tons of silver, accumulated across cartel networks over roughly a decade and a half of systematic extraction. At today's silver price of approximately $80 per ounce, we're talking about a reserve worth north of $500 billion. Let that number breathe for a second. $500 billion in physical silver, sitting in warehouses, underground vaults, and dispersed caches across northern and western Mexico, controlled by organizations that answer to no government, no central bank, and no market regulator on Earth. Now here's where the story gets a dimension most financial commentators are completely missing. This didn't happen in isolation from American policy. For months leading up to the February strike, the Trump administration had been applying extraordinary diplomatic and economic pressure on the Mexican government, threatening tariffs, border closures, and military cooperation withdrawal, demanding that Mexico extradite cartel leadership to American courts. Mexico, facing its own political calculus, eventually complied in a way that shocked even seasoned observers. In a compressed time frame that Mexican officials later described as unprecedented, approximately 100 cartel bosses and mid-level commanders were handed over to American custody. 100. The The organizational trauma to both CJNG and Sinaloa networks was severe and immediate. What nobody in Washington's policy planning sessions apparently wargamed adequately was the economic retaliation mechanism. When you remove the leadership of organizations that have embedded themselves into legitimate industrial supply chains, and make no mistake, the silver mining corridor in Mexico is exactly that kind of embedded supply chain. The disruption doesn't stay contained to the criminal network. It bleeds into everything those networks touched. And they touched everything. Mining operations in Jalisco and Zacatecas don't just employ cartel members. They employ tens of thousands of ordinary Mexican workers, geologists, engineers, truck drivers, and equipment operators, many of whom pay informal taxes to cartel-connected security providers, who also happen to be the only force capable of guaranteeing that the roads stay open and nobody gets kidnapped. Remove that network suddenly, and you don't get freedom. You get a vacuum. And into that vacuum rushed exactly the kind of chaos that makes industrial operations impossible. Have you ever tried to ship $40 million worth of silver concentrate when there are armed men at the highway checkpoint who no longer have any reason to let you pass? When your transit insurance has been voided because the route is classified as a conflict zone? When the Mexican federal police are stretched thin responding to cartel retaliation attacks in 3 states simultaneously? The answer is, you don't ship it. You stop. You wait. And while you wait, the world's silver supply, your silver supply, the silver inside your electronics, your solar panels, your medical equipment, the silver that makes electric vehicles work, quietly starts running short. Pop quiz. How many days of above-ground silver inventory does the global industrial market actually carry? Now, you might guess weeks, maybe a month or 2. The answer, based on data from the Silver Institute's most recent demand assessment, is closer to 12 to 18 days for certain industrial categories when supply chains experience a significant disruption. 12 days. That's how thin the margin is between normal operations and genuine shortage conditions in the silver market. So, when 24% of global silver production goes behind a cartel blockade on a Sunday morning in Jalisco, the clock starts ticking immediately. Not in months, not in weeks. The industrial buyers who contract for silver deliveries start making phone calls on Monday morning. The commodity desks at major banks start running shortage scenarios by Tuesday. And the retail investor, the everyday American who holds silver as a hedge or is thinking about it or whose retirement fund is exposed to silver-dependent industries, is usually the last to know that something has fundamentally changed in the market underneath them. That's the setup. And what happened next? What Vizla Silver's engineers discovered in January, what the CME's warehouse data is quietly screaming right now, and what a pattern going back to 1910 tells us about where silver prices go when Mexican mines become battlefields. That's the story we need to walk through carefully, because the math here leads somewhere very specific. And very soon. January 23rd, 2026. A convoy of vehicles carrying 10 mining engineers and geological surveyors working for Vizla Silver Corp is moving through Sinaloa State en route to the Panuco project site, one of the highest grade silver discoveries in the Western Hemisphere, a deposit carrying reserves estimated at 186 million ounces. The road is one they've traveled dozens of times. And then the convoy stops. Armed men emerge from the brush on both sides of the highway. Within minutes, all 10 workers are gone, absorbed into the vast, ungoverned interior of Sinaloa cartel territory. 5 of those men never came home. Let that sit for a moment, because it's easy to read a statistic and let it blur into the noise of a news cycle that moves faster than we can process. These were geologists, surveyors, engineers, professionals with families, with mortgages, with kids in school, people who chose careers measuring rock formations rather than trading on Wall Street. They went to work in Mexico because that's where some of the most extraordinary silver deposits on Earth happen to exist. And they walked into the middle of a war that most Americans didn't even know was being fought. The Sinaloa cartel's targeting of Vizla Silver wasn't random. This is critical to understand. The Panuco mine sits in territory that the Sinaloa organization considers a revenue jurisdiction, meaning any commercial extraction happening there is, in the cartel's operational logic, subject to their authority. When the Mexican government began cooperating with American extradition demands and handing over cartel leadership, Sinaloa's response was to demonstrate economic leverage. And nothing demonstrates economic leverage faster than shutting down a mine that produces silver for global industrial supply chains. The kidnapping was a message, written in the language that international commodity markets actually understand: disruption. Vizla Silver halted all field operations immediately following the incident. A company sitting on 186 million ounces of high-grade silver, enough to supply a significant portion of global industrial demand for months, went completely dark. No surveys, no drilling, no shipments. The Panuco mine, which had been on track to become one of North America's most significant primary silver producers, was effectively frozen by 5 men's deaths and the armed will of an organization responding to American foreign policy decisions made thousands of miles away in Washington. Here's where the numbers start to compound in a way that should make every American investor lean forward. Vizla's Panuco project represents roughly 186 million ounces in known reserves. That's significant on its own, but pair it with what CJ&G's simultaneous blockade was doing across Jalisco and Zacatecas, and you begin to see the full geometry of the supply crisis taking shape. Mexico is not merely an important silver producer. Mexico is the world's single largest silver-producing nation, responsible for approximately 26 to 27% of global annual output in recent years. Within Mexico, the states of Jalisco, Zacatecas, and Sonora, the precise geography that CJ&G controls or actively contests, account for the overwhelming bulk of that production. When analysts at the Silver Institute and the World Silver Survey calculate Mexican output, they're largely calculating what moves through cartel territory. That has always been the uncomfortable truth sitting beneath the commodity data. The cartels don't just tax the mines. In many corridors, they are the de facto permitting authority, the security infrastructure, and the logistics backbone. Without their cooperation, or at minimum their tolerance, silver doesn't move. Post-strike, that tolerance evaporated. CJ&G checkpoints appeared on the federal highways connecting mining districts to processing facilities and export terminals. Truck drivers reported being turned back at gunpoint. Mining company security coordinators, the people whose job it is to negotiate informal passage arrangements with local power structures, found themselves dealing with mid-level commanders who had no authorization to make deals, whose leadership had been either killed, arrested, or was in hiding. The informal agreements that kept silver flowing through dangerous territory simply ceased to function because the people who honored those agreements were gone. The aggregate impact on silver flows is what the Silver Institute's emergency assessment, circulated quietly to institutional subscribers in late February, described as a 24% reduction in global available supply, not projected, not modeled, but actively occurring based on real-time export data from Mexico's mining secretariat. 24% of global silver supply frozen. To put that in a context that hits closer to home, imagine waking up tomorrow and discovering that every solar panel manufacturer, every electric vehicle battery supplier, every semiconductor fabricator, every medical device company that depends on silver, and there are thousands of them, is suddenly drawing from a pool that's nearly a quarter smaller than it was last month. The industrial demand doesn't shrink. The demand is actually growing. Global solar installations alone are projected to require record silver volumes through 2026 and beyond, according to the International Energy Agency's renewable capacity forecasts. What shrinks is the supply. And that collision between shrinking supply and growing demand is the fundamental engine of every major silver price event in modern history. Which brings us to a pattern that historians of commodity markets find almost uncomfortably familiar. Cast your mind back to 1910. Mexico is heading toward revolution. The long, grinding collapse of the Diaz regime is accelerating, and the countryside is beginning to mobilize. The mines of Sonora and Chihuahua, which at that time supplied a substantial portion of the world's silver output, begin to experience exactly what we're seeing today. Armed conflict disrupting transport, workers fleeing dangerous zones, foreign mining companies evacuating personnel, and the informal security arrangements that kept operations running dissolving into factional chaos. Between 1910 and 1915, silver mine output from Mexico dropped catastrophically. The London silver market, which at the time was the global pricing benchmark, saw silver prices surge by roughly 300% from their pre-revolution lows as the market absorbed the reality of a structural supply shock from the world's most important producing nation. Investors who understood what was happening before the mainstream financial press caught up, who recognized that political violence in Mexican mining districts was not merely a human tragedy, but a commodity market event of the first order. Those investors saw extraordinary returns. The ones who waited for consensus, who waited for the headlines to confirm what the supply data was already screaming, largely missed the move. We are watching that pattern activate again in real time in 2026, and the parallel isn't approximate or loose. It's structurally precise. A major political disruption in Mexico, centered on the removal of entrenched power structures. An immediate retaliatory shutdown of mining operations in the country's most productive silver regions. A supply shock propagating through global commodity markets at exactly the moment when industrial demand is at a historic high. And a mainstream financial media that is right now focused on equity markets, Federal Reserve rate decisions, and geopolitical headlines, while the silver supply story builds quietly in the background like pressure behind a sealed valve. What makes this cycle potentially more acute than 1910 is the speed of modern industrial dependence. In the early 20th century, silver's primary role was monetary. Coinage, reserve backing, trade settlement. Silver demand was significant, but relatively elastic. You could substitute gold in monetary functions, slow down coinage, adjust. Today's silver demand is overwhelmingly industrial and largely inelastic. You cannot make a solar panel without silver. You cannot manufacture the connectors in a modern electric vehicle battery pack without silver. You cannot produce the medical imaging equipment that hospitals depend on without silver. These aren't discretionary purchases. These are embedded requirements in the supply chains of the technologies that our entire economic transition toward clean energy depends upon. When silver supply contracts by 24%, the manufacturers don't shrug and find an alternative. They compete ferociously for whatever remaining supply exists, and that competition drives prices. The commodity desks at JP Morgan, HSBC, and Citigroup have silver analysts. Right now, those analysts are looking at Mexican export data, CJNG checkpoint reports, Vizla's operational suspension, and CME warehouse inventories, and they are running the same calculation that takes us to a very specific number by a very specific date. We'll get to that number in a moment. But first, consider this. The last time silver experienced a supply disruption of comparable magnitude, not 24%, but even half that, combined with the kind of industrial demand growth we're seeing from the clean energy sector, the price response was measured not in percentage points, but in multiples. The evidence is no longer circumstantial. It's quantitative, it's documented, and it's moving. 5 engineers died at the Panuco mine in January. 6,300 metric tons of cartel-held silver are now in operational limbo. 24% of global supply is behind checkpoints manned by armed men who have every incentive to keep it there. And the historical precedent from 1910 tells us, with uncomfortable clarity, that when Mexican silver mines become battlefields, the price response is neither small nor slow. The only question left, the one that determines whether you benefit from understanding this or simply watch it happen to you, is what comes next in the math. Let's do the math together, because this is where the abstract becomes personal, where a cartel blockade in Jalisco translates directly into dollars in your portfolio, or dollars you left on the table because you didn't know what was happening until it was already over. Start with supply. Global silver mine production in a normal year runs approximately 820 to 840 million ounces, according to the Silver Institute's annual World Silver Survey. Mexico contributes roughly 200 to 220 million ounces of that total in a healthy operating environment. When you factor in the Vizla Panuco suspension alone, 186 million ounces of reserve-backed annual production capacity, offline, and layer on top of that the CJNG checkpoint blockade effectively freezing active shipments across the broader Jalisco and Zacatecas corridor, you arrive at a supply reduction that commodity analysts are currently calculating at approximately 190 to 200 million ounces on an annualized basis. Nearly 200 million ounces, gone from the available supply picture. Now look at demand. The Silver Institute's most recent demand forecast, published before this disruption even occurred, already projected a structural deficit for 2026, meaning the world was on track to consume more silver than it produces even under normal supply conditions. The deficit was estimated at roughly 150 to 180 million ounces for the full year. Stack the Mexican supply shock on top of a pre-existing deficit, and you're no longer talking about a market that's tight. You're talking about a market that is, by any rigorous commodity analysis standard, in acute shortage. The math resolves to a combined supply pressure of well over 300 million ounces, in a market that trades roughly 1 billion ounces annually. That's a 30+% effective supply contraction, hitting a market with no meaningful short-term substitutes and accelerating industrial demand. Here's what that does to price. Commodity markets are not perfectly efficient. They lag. Physical supply tightness takes weeks to fully register in futures pricing because traders are initially working from contract positions, existing inventory buffers, and hedged supply agreements that temporarily insulate the spot price from reality. But that insulation has a shelf life, and we can measure it by watching one specific number: CME Group warehouse inventories, which represent the physical silver sitting in registered COMEX vaults, the actual metal available for delivery against futures contracts. Those inventories have been declining at approximately 15% per month since the disruptions began. 15% per month. To put that in perspective, when CME silver inventories drop consistently at that rate, the futures market begins pricing in delivery risk. The very real possibility that if you hold a silver futures contract to delivery, there may not be enough registered metal to fulfill it. That's the moment when paper price and physical reality snap violently together, and the price discovery process stops being theoretical and starts being urgent. Starting from silver's current price of approximately $80 per ounce, the 35% price adjustment that a 24% plus supply freeze historically generates, validated both by the 1910 Mexican Revolution data and by the more recent 2020-2021 supply disruption cycle, when pandemic-related mine closures combined with a retail investment surge to push silver from $14 to $30 in under 12 months, takes us to a target range that multiple independent commodity analysts, including those tracked by the Bloomberg Commodity Desk and cited in recent Kitco market commentary, are converging on $110 per ounce by June 30th, 2026. That's not a speculative moonshot. That's a 37.5% move from current prices, grounded in a supply-demand calculation that uses publicly available data from the Silver Institute, the CME's own warehouse reports, and Mexican Mining Secretariat export figures. The $110 target assumes no further escalation, no additional mine closures, no expansion of CJNG retaliation into other industrial sectors, no secondary panic buying from institutional investors who are currently underweight silver relative to historical allocation norms. If any of those additional pressure points activate, the ceiling moves higher. Now let's talk about what's making a quick resolution unlikely, because one of the most common mistakes investors make when evaluating commodity disruptions is assuming that supply shocks are temporary and self-correcting. Sometimes they are. This one has structural features that suggest otherwise. First, transport insurance. Lloyd's of London and the major marine and cargo insurers who underwrite the movement of precious metals through Mexico have, according to industry sources cited by mining.com in February 2026, begun reclassifying active mining corridors in Jalisco and Sinaloa as conflict zone territory. This isn't bureaucratic caution. It has direct operational consequences. When a mining company can't get transit insurance for silver concentrate shipments, those shipments don't move. Period. Even if a company wanted to negotiate informal passage through CJNG checkpoints, their corporate liability exposure without valid insurance makes the decision legally impossible for any publicly traded entity. The silver sits. Second, the human capital problem. Geologists and mining engineers are a globally mobile, highly specialized workforce. They go where the work is safe and the pay is good. When 5 colleagues are kidnapped and killed at a site in Sinaloa, the remaining technical workforce at every Mexican mine within CJNG and Sinaloa contested territory makes a rational personal calculation. Many of them have already made it. Industry sources tracking personnel movements report that a significant number of expatriate technical specialists have left Mexican mining projects since January, with relocation requests accelerating sharply following the February 22nd strike and its aftermath. You cannot run a modern silver mine, a complex industrial operation requiring continuous geological assessment, environmental monitoring, and precision extraction. Without qualified technical personnel, when they leave, the operation degrades. Restarting once they're gone takes not weeks, but months, sometimes years. Third, and perhaps most consequential for our timeline, the political resolution path is genuinely unclear. The Trump administration's position on cartel extraditions is not softening. If anything, the February strike suggests an escalating posture. Mexico's new government, navigating its own internal political pressures from states where cartel economic influence is deeply embedded, is in an extraordinarily difficult position. Negotiating with CJNG to reopen mining corridors would require either a formal security agreement, which no government can publicly announce with a criminal organization, or a gradual informal restoration of the arrangements that existed before the crackdown. That restoration, even if politically viable, takes time. It requires rebuilding trust between mining company security liaisons and cartel middle management in a post-leadership vacuum environment. Every month that process takes is another month of 15% CME inventory decline. Think about what this means practically for the American investor looking at their portfolio right now. If you hold silver ETFs, SLV, SIVR, or physically backed alternatives, the value of those positions is about to be recalculated by a market that is just beginning to fully price in what we've walked through together in this conversation. If you're considering silver mining equities, the companies operating outside Mexico's conflict corridor, First Majestic's operations in safer jurisdictions, Pan American Silver's diversified geographic footprint, are positioned to capture significant premium as buyers redirect demand away from disrupted sources. And if you hold physical silver, the spread between spot price and dealer premiums for immediate delivery is already widening, which is itself a real-time signal that physical tightness is outrunning the paper market's acknowledgement of it. Here's the longer view that ties everything together, because it's important that we don't just see this as a single event. Pull back the chart to 2021 and look at the silver deficit trend. In 2021, the Silver Institute recorded the first significant structural deficit in the modern silver market, demand exceeding mine supply by a meaningful margin for the first time in years. In 2022, the deficit grew. In 2023, it grew again. In 2024 and 2025, driven by explosive solar panel deployment and EV production scaling globally, the deficit deepened further. Each year, the market has been drawing down above-ground stockpiles to bridge the gap between what mines produce and what industry consumes. Each year, that buffer has gotten thinner. The Mexican supply shock of early 2026 didn't create a silver shortage from a position of abundance. It detonated a supply crisis into a market that was already structurally depleted, already running on thinning inventory margins, already priced for a world where Mexican silver kept flowing reliably. That world ended on February 22nd. What if I told you that the people best positioned to understand this, the commodity desks at major banks, the fund managers who track Silver Institute data monthly, the industrial procurement officers at solar manufacturers who are already locking in forward contracts at prices above spot, are not waiting for the mainstream financial press to catch up? They are acting now, quietly, because the window between when supply data tells the truth and when price fully reflects that truth is historically short and historically lucrative for those paying attention. You now have the same information they have: the strike in Jalisco, the Vizla kidnappings, the 6,300 tons of frozen cartel silver, the 24% global supply blockade, the 15% monthly CME inventory drain, the 1910 historical parallel, the $110 June target. Every piece of this is grounded in documented data, verifiable supply chain reporting, and a commodity market math that has played out with remarkable consistency every time political violence and Mexican silver mining have collided throughout history. The question was never whether this was real. The question was always whether you'd know about it in time to do something with the knowledge. We've walked through it together. The window to the June 30th target is narrowing every single week. What you do next is yours to decide. But at least now you're deciding with your eyes open, which is exactly the position every American investor deserves to be in. Stay informed, stay ahead. And remember, in commodity markets, the best informed person in the room is almost always the one who acted before the room figured out what was happening.